Welcome back, guys, to part 2 of this individual analysis of Royal Caribbean. If you haven't seen part 1, I suggest you go check it out because there is a ton of useful information that is really important before you come and watch this part. So go check that part out. But welcome to part 2. And of course, as I said at the end of the last part, in this bit, we're going to have a look at management, how effective they are at investing within the business and also managing their debts. And then lastly, we're going to have a look at the intrinsic value of Royal Caribbean, calculate how much it's worth and how much we should be willing to pay for it. But let's continue and start by talking about management, because after all, they are the ones that are making investment decisions on our behalf within the business. I like to start by looking at how effective they are at investing within the business, because ultimately their investment decisions within the business are going to impact how much cash the business can produce over the next 10 years, which is where we're looking to make our money. So of course, we want to start by looking at the ROIC, the return on invested capital, to see what kind of return they're getting on their money. Royal Caribbean's 5-year average is 7.1%, which is just a little bit too low for my liking. So I like to see that number above 10%. And then the 1-year average, we've got 10.37%, which is great. It's above our 10% minimum requirement, and it is above the long-term average, which means that they are getting better over time. So it is trending in the right direction, but we will have to see if they can continue to invest at double digits over the next few years to see that they can consistently do it for us as investors. However, they have been showing that they have made efforts in other areas in order to compound the wealth of the shareholders, and they clearly have a focus on returning money to the shareholders. Despite revenue growth being stable at 3%, over the past 3 years, they've been making massive efforts in order to grow earnings and equity, and they've been able to grow earnings at 20+% and cash flow at 20+%. And also grow equity at 9+%, which is really strong if we can see that continue over the next few years. Also, over the past 3 years, from 2014 to 2017, they set themselves a goal called the double goal. And essentially that was to, 1, they wanted to double their earnings per share, which they successfully did within that time. And the second thing is that they wanted to achieve double digits return on invested capital. And of course, as I just said, they have a 10.37% return on invested capital. So they also meet that requirement. So they're setting themselves goals to return more value to the shareholders, and they're also hitting those goals. So that is great. That's a really great sign to see from your management team. Then of course, we want to have a look at debt management. Do they have any out of control debt obligations, and how have they been at managing their debt in the past? For this, I like to start by looking at the current ratio, and the current ratio for Royal Caribbean is 0.18, which is a terrible current ratio. And this is really just the result of 2 types of liabilities. The first one is called deferred revenue, and this is one that we should actually remove from the current ratio formula, because it's just something that is a consequence of the type of industry that Royal Caribbean operates in. And I'll explain what I mean by that. So because most customers pay for their cruises 1 or 2 years in advance, it means that they're going to have a liability called deferred revenue on their balance sheet until those people have been on their cruise. If we take deferred revenue out of the current ratio formula, the current ratio becomes 0.33, which is better, but it's still really bad. And that's as the result of the second liability, which is their short-term debt. They currently have 6.3 billion in long-term debt and 1.2 billion in short-term debt that is due in the next 12 months. So this is basically because they've had a history of using a portion of cash and a portion of debt in order to buy or build new cruise ships, and also to make acquisitions in the cruise line industry. And this is great with low levels of debt, because it basically just increases the rate at which they can grow the business and ultimately grow our cash flows. However, this debt does add a lot of risk, because if we go into a recession, customers are going to be paying less and putting off their holidays, which means the company has less cash to pay off its debts. And coupled with that, there's often higher interest rates, which means that the interest payments on those debts are also going to go up, which means that these companies that have a lot of debt and that are cyclical businesses are at risk of going bankrupt if they can't manage their debt properly. So for this reason, it's really important to only invest in businesses with really manageable levels of debt. And for me, that means that they need a current ratio of above 2 and a debt to equity ratio that's below 0.5. And for Royal Caribbean, it fails both of these tests. So that brings us to the intrinsic valuation. How much do we value this company based on everything we've just talked about? And we're going to use 4 different methods. We're going to use the margin of safety method, we're going to use an owner's earnings method, we're going to use a payback method, and we're going to use the classic discounted cash flow method, which is the method that Warren Buffett uses. And we're going to see what kind of valuation we can come up with using these valuation methods. So if we start off with the margin of safety method, we need to make a few assumptions. One of the first assumptions that we need to make is about the return that we're going to get. We're going to assume that we want a 13% return from the stock price appreciating, and we're going to assume that we can get a 2% dividend from this stock each and every year, and ultimately put that together, that will give us a 15% return per year for the next 10 years. The next assumption we need to make is the growth rate, and essentially I've picked 2 different growth rates to give us a range of values. At the upper end, I've got 12%, which is the long-term EPS growth rate of Royal Caribbean, and it's also the estimated growth rate from analysts. On the other end, we've got 5%, which is the long-term equity growth rate of this company, and equity growth over the long term is what I like to use in predicting where these companies will go in the future. So using those assumptions, we come up with a fair value range of somewhere between $60 and $115 per share. And that would give us a buy price range of somewhere between $30 and $58 per share. So then let's move over to the payback time, and we only need to make one assumption here, and that is that they're going to be able to grow their cash flows at 5% per year for the next 10 years. And basically what we're doing here is we're looking for a payback time of less than 8 years, which means that from when we invest, within 8 years, we have recouped our initial investment, and everything beyond that is going to be pure profit. So for an 8-year payback time, that means we would be willing to pay a market cap for the entire business of $25 billion, which gives us a stock buy price of about $120 per share. If we then move on to the 10 cap method, we need to take the owner's earnings, which is an estimation that I've made from their free cash flow of about $2.54 billion. We then just times that by 10 to get our buy price for the entire business, which is again about $25 billion. And as the same as the payback time, that gives us a buy price of about $120 per share. So the last method we've got is a discounted cash flow. And this is a really traditional method of valuing assets that is used in finance. And essentially we're gonna take the cash flow from last year, which I've calculated an owner's earnings of $2.54 billion. We're gonna use a discount rate, which is the 10-year bond rate, which is currently 2.7%. We're going to use an earnings growth rate of 5% per year for the next 10 years. And that is going to give us a present value or an intrinsic value of $27.4 billion for the entire company. We then need to provide a significant margin of safety from that intrinsic value. So approximately we would be willing to pay about $10 billion for the entire company, which gives us a stock buy price of about $48 per share. So this is really interesting because we've got 2 methods that say it's a buy at about $120 per share. Then we've got 2 methods that say it's a buy at somewhere between $30 and $60 per share with an intrinsic value of somewhere between $60 and $120 per share. So all of them are coming back to around that $120 per share of intrinsic value based on the growth rates of 5 or 12%, whichever we're using, being conservative or being a little bit less conservative. But essentially, if I was going to be investing in this company, I would of course be being very, very conservative. I'd be looking at that $30 to $50, $30 to $60 range. And that's simply because of that added risk from the debt. It means that we want to pay a lot less to ensure that we make a satisfactory return in the event that they can't pay their debts and the company goes bankrupt. So if we have a really massive margin of safety on 4 or 5 different companies, if one of them goes bankrupt, it's okay because the other ones will earn a much superior return to make up for a company going bankrupt. But of course, that is if I was to invest in this company, and considering their debt position, I probably wouldn't, just because it's too much risk. There's plenty of companies out there that don't have that debt risk that we could invest our money in. If we go into a recession and stock prices are really cheap, then there's going to be plenty of bargains available. So we don't have to invest in companies that have that added debt risk. The current stock price for Royal Caribbean is about $100 per share. So that 30 to 60 range is a long way off. However, in the last recession, Royal Caribbean stock actually dropped 90% from its peak in 2004. Just to put that in perspective, Royal Caribbean peaked again back earlier this year at $130 per share. So in order to get to $30 per share, the stock would have to fall 75%, which is a long way. However, as I said, in the previous recession, it fell 90%. So 75% wouldn't be ridiculous and it wouldn't be unusual. I hope you guys enjoyed this one, and I want to hear your thoughts on Royal Caribbean, whether you guys think that it's a buy, whether it's worth the risk, and what price would you guys be looking to make an investment. So make sure you let me know down below. Hit like if you enjoyed the video, and of course, if you want to see more, become a subscriber, hit that subscribe button and hit that notification bell so you don't miss out on any of the videos coming out in the future. But I hope you guys enjoyed this one, and I hope you guys have a great day, and I'll see you in the next one.